Today we're going to look at long-term contracts and how they're accounted for across time. The first example that we're going to work with is overall positive gross profit for the contract and positive gross profit each year. So let's get started. We have this example. Lorna Corporation recognizes revenue over time for long-term contracts. At the date the contract is signed, the contract price is $600,000 and the expected cost to complete the contract are $400,000. The following information is available. So notice that we have here cost incurred to date and $100,000 in year one, $300,000 in year two, and $500,000 in year three. At the end of year one, we thought there was only going to be an additional $300,000. But by the end of year two, we saw that we were going to have an overrun in terms of cost. We had a cost so far of $300,000 and an additional estimated cost of $200,000, so a total of $500,000. The billings are really irrelevant to when we record the profit and the revenue. And so for that, we're going to leave the billings off. The question is, what is the amount of revenue to be recognized during year two? And that requires that we first estimate the year one revenue. And because when we would do an accumulation of revenue and gross profit, and we subtract everything that's already previously recognized. Let me show you. In year one, we had $100,000 of cost, and then we estimated an additional $300,000. So based upon that information only that was available at the end of year one, we were $100,000 out of a total estimated cost of $400,000. We had at approximately 25% finished. And then next, we're going to estimate the year one revenue and gross profit. Well, we have the contract price of $600,000 times the part that was complete at year end, which was 25%. We just went over that. For total revenue that we're recognizing in year one of $150,000. And we know we incurred costs of $100,000, so our year one gross profit is $50,000. So the key things to remember, $150,000 of revenue in year one and $50,000 of gross profit in year one. Now let's move on to year two. Let's estimate the year two portion that's complete. Well, we had an additional $200,000 of costs that we incurred in year two. We had to add the cost that we incurred in year one, the $100,000, so that gives us the $300,000 cost incurred to date, $300,000, plus the $200,000 that we estimate that we're going to have in year three, for a total of $500,000. So far, we've expended the $300,000 of the total $500,000, or 3 over 5 is 0.6. We're 60% of the way done at the end of year two. So based on that, we take the contract price of $600,000 times 60% is $360,000, and we subtract the revenue we recognized in year one, $150,000, and that gives us the additional revenue to recognize in year two, $210,000. Less the cost that was incurred in year two, that is the $300,000 minus what we had previously, the cost incurred to date minus the last year's, or $200,000, and we have gross profit of $10,000. So in year two, we have $210,000 of revenue and $10,000 of gross profit. Now let's move on to year three. In year three, we are 100% complete. So we recognize by the end of year three, $600,000 of the $600,000 contract price, minus what we recognized in the prior years. That is the 150,000 in year one and the 210,000 in year two, that gives us 360,000. Therefore, we're going to subtract that from the contract price, we get 240,000. Minus the cost that was incurred, that is, we had 500,000 by the end of year five, minus what we had incurred by the end of year two of 300, we have an additional cost of 200, and our gross profit is 40,000. So in summary, we look at it like this. We see revenue in the first year, 150,000, and gross profit of 50. In the second year, 210,000 and gross profit of 10,000. In the third year, revenue of 240, gross profit of 40. And we add them up, the total is the 600,000 revenue in the contract and the $100,000 gross profit. That is the contract price minus the total costs incurred, 600 minus 500, $100,000 of gross profit. That's how we allocate revenue and gross profit across each of the 3 years, assuming we have positive overall gross profit and positive gross profit in each of the 3 years.